Welcome to the deep dive. We're here to take that stack of sources you've got and turn it into clear, usable knowledge. Today we're doing a pretty major deep dive into ICRA Ltd, one of India's big credit rating agencies. We'll be going through their latest financials, consolidated, standalone, some strategic updates, and their macroeconomic forecasts. This all centers around their Q2 and H1 results ending September 30th, 2025. Our goal here, to quickly get a handle on their financial health, understand a really big acquisition they just made, and pull out their market predictions for FY 2026. And look, if you remember just one thing to start and make it this, their consolidated profit after tax, the PAT, really shot up. For Q2 FY 2026, it jumped, get this, 29.4% compared to last year.
Yeah, that 29.4% in Q2 is huge. And, it wasn't just a flash in the pan. H1, the first half, was up 24.4% too. That's definitely the headline grabber. We've confirmed all this from the source docs, the unaudited financials, the investor presentation, press release, the whole lot. And importantly for you, Deloitte Haskins and Sells, the auditors, did a limited review. They gave an unmodified conclusion. So basically, they're saying the numbers look sound from their perspective.
Okay, right. Let's unpack those numbers a bit more because that difference between how much revenue grew and how much profit grew, that tells the story, doesn't it? So the top line, the revenue, it looks, well, healthy, consistent. Q2 consolidated revenue from operations was 136.6 crore. That's up 8.3% from the year before. And for the whole first half, H1 revenue hit 161.1 crore, which is up 8.4%. Pretty steady growth there.
Exactly. So you've got roughly 8% revenue growth leading to, like you said, nearly 30% profit growth in Q2. That screams operational leverage, right? It's not just about getting more business volume. It clearly shows they're managing costs well, getting more profit out of each rupee of revenue. That's a sign of a well-oiled machine, especially in professional services.
Right. Leveraging their fixed cost people, infrastructure. And that kind of strong performance, that momentum, it backs up what the MD and Group CEO said. He pointed to strength in the core ratings business and also good traction in research and analytics, especially winning new clients there.
Yeah, they're not just sitting back. They're actively expanding margins while grabbing market share. It shows confidence. I mean, look at the detail in the source docs about the board meeting where they approved these results. October 28th, started 4:18 p.m., finished 6:42 p.m. Pretty efficient.
Wow.
And they weren't just approving results. They already had this major strategic move, the acquisition, basically done and ready to announce right after the quarter ended.
That timing is interesting. And that profit acceleration, it feels like it wasn't just the core business doing its thing. It suggests maybe a shift towards higher margin activities, which is a perfect segue, really, into the Fintelix acquisition.
A huge strategic move that could really change their game in risk analytics.
Oh, absolutely pivotal. This happened just after the reporting period. On October 17th, 2025, ICRA bought Fintelix India Private Limited. Fintelix is based in Bengaluru. They're in the RegTech and risk solutions space. So while its impact isn't in these Q2 financials we just talked about, you can bet it's central to their FY 2026 plans.
And they clearly put their money where their mouth is. The total deal size was 253.25 crore. That's roughly what? 29 million US, all cash too. They got 98.75% upfront for most of that cash, with a tiny bit left pending some formalities. Yeah, and the why behind it is pretty clear when you look at what Fintelix does. Regulatory reporting, credit risk stuff, supervisory platforms, data analytics. It's complex stuff. ICRA explicitly said their goal is unified risk and analytics solutions. So the synergy seems obvious, right? Fintelix gets access to ICRA's huge list of banking and financial clients, particularly for domestic growth, and ICRA. They instantly get these sophisticated, high-tech products they need to really lead in this RegTech area, which is just growing like crazy.
And Fintelix wasn't small potatoes either. Their FY25 revenue was around 91 crore, with a decent EBITDA margin, like 20%, and nearly 400 employees. So, yep, this isn't a minor tech tuck-in. It's a serious buy aimed right at helping clients navigate and ICRA profit from this complex regulatory environment. Okay, so that's the big strategic picture. Now let's circle back and dig into how the two main business segments actually performed in Q2 and H1. These are the engines that generated the cash for that acquisition. We've got ratings and ancillary services and then research and analytics.
Right. Ratings and ancillary services was definitely the powerhouse for profitability in this period. Q2 revenue was up 13.0% year-on-year. H1 up 13.6%, solid growth. But interestingly, the market conditions they were operating in were actually pretty mixed, kind of challenging in some ways.
Yeah, that's what I saw too. Like bond issuances actually fell, down almost 11% in Q2, apparently because yields were rising and maybe people were waiting for rate cuts.
Exactly. Investors were a bit hesitant on bonds, But then borrowing shifted. You saw overall bank credit growth slow down a bit year on year. But crucially, large companies started turning more to banks for funding in Q2, maybe finding it better than tapping the markets then.
Ah, okay. So that shift kept the demand for ICRA's rating services going strong, even if bond volumes were down.
Precisely. And other areas held up too. Commercial paper, which ICRA rates a lot of, stayed pretty active. Favorable short-term rates helped there, plus demand from brokers. And securitization also grew, things like pools of vehicle loans and home loans from NBFCs getting packaged up. So that diversity helped cushion the blow from lower bond issuance.
And despite that mixed market, the quality of their ratings seems really strong. The source highlights the investment-grade default rates still very low, just 0.7% in the first half. Plus, their credit ratio, that's upgrades versus downgrades, looks healthy. For H1, it was 1.5.
Yeah, a 1.5 credit ratio is good. It means for every, say, 10 downgrades, they had 15 upgrades. The actual numbers were 19% upgrades, 13% downgrades, and the rest, 75%, were just reaffirmed. So low defaults plus more upgrades than downgrades. It suggests their rated companies are generally stable and their initial assessments hold up well. That builds confidence.
Okay, that covers ratings. Now the other segment, research and analytics. The growth there was, well, much slower. Q2 up only 2.1%, H1 up 1.8%. What was going there?
Well, there were some bright spots. They mentioned expanding their security valuation services beyond just asset management companies, which is good diversification. And some newly launched risk management solutions apparently gained some traction. The knowledge services part also saw decent broad growth.
There's always a but, isn't there?
There is. The report explicitly calls out that the overall segment growth was held back by the, and I quote, residual impact of the ESG project discontinuation. So it seems a strategic decision to stop a particular ESG initiative had a lingering negative effect on the top line for this segment. A reminder that strategic shifts can sometimes cause short-term pain.
Interesting. And that slowdown or that specific drag maybe makes the Fintellex acquisition seem even more important for this segment's future, right?
Yeah.
To inject new growth.
Absolutely. Fintellex slots right into the future growth drivers here.
Yeah.
Risk management and regulatory compliance. Think about things like the new expected credit loss or ECL rules for banks. There's growing demand for sophisticated early warning systems, EWS tools. Fintellex gives them the tech to deliver these integrated solutions, probably much faster than building it all themselves.
Right. Helps them capitalize on that mandatory compliance spend.
Okay, so we've looked inward at ICRA's performance and strategy. Now let's zoom out. ICRA Research also put out their projections for the broader Indian economy for FY 2026. This gives us context for everything else.
And domestically, things look pretty positive, according to their forecast.
Largely, yes. They're projecting real GDP growth to stay quite solid, plus 6.5% for FY 2026. And here's a big one. They expect inflation, CPI inflation, to cool down significantly, like dropping from 4.6% estimated for FY25 way down to 2.6% in FY26. It's a massive drop if it happens.
Wow, 2.6% inflation. That would certainly give the central bank room to maneuver.
Exactly. And that's why ICRA is suggesting another rate cut, maybe 25 basis points, is likely as soon as December 2025. Add to that an expected improvement in the fiscal deficit. They see it narrowing from 4.8% of GDP to 4.4% in FY26. So yeah, the domestic picture looks pretty supportive for businesses.
Okay, supported domestically. But these reports always have a section on risks and uncertainties, and ICRA seems quite focused on external factors here. These don't feel like minor worries.
No, they're quite explicit. Geopolitical tensions are mentioned, of course, but the real specific concern flagged is the impact of steep U.S. tariffs on Indian exports. They directly link this tariff uncertainty to potentially weighing on export performance and, maybe more importantly, causing delays in private capital expenditure, private CapEx. Companies holding back on big investments until there's more clarity, maybe waiting for some kind of India-U.S. trade deal, and delayed CapEx. That obviously impacts future growth and future demand for ratings.
And they call it another major risk, specifically hitting that research and analytics segment and IT services exports generally.
Yes, a really big one. They mention pressure from a proposed U.S. law called the HIRE Act, stands for Halting International Relocation of Employment Act. The concern is that this act could slap a potentially 25% tax on payments for services performed overseas. If something like that actually happened, well, you called it a hurricane, that would be a massive blow to the Indian services export model.
25% tax. Ouch. That's huge.
It is. But interestingly, despite highlighting these pretty severe external risks, ICRA still maintains that the domestic tailwinds are strong. They see urban and rural consumption staying robust, helped by potential tax cuts, those expected rate reductions we mentioned, and hopefully good monsoons. So you have this real tension, this contradiction. Strong faith in domestic demand, but facing these significant external headwinds, especially on trade and services. That seems to be the tightrope they see India Inc. walking.
Okay, so let's try and wrap this up. Summing up our deep dive here. ICRA delivered really strong profits in the first half of FY26, much faster growth in revenue, showing good efficiency. That performance seems validated by the quality of their ratings, low defaults, positive credit ratio, and critically, they made a big strategic bet on the future with the Fintelix acquisition, positioning themselves right in the path of growing demand for regulatory tech and risk analytics solutions. Makes sense.
Absolutely. And that strategic pivot, combined with the macroeconomic outlook they provided, leaves us with a final thought for you, the listener, to chew on. ICRA's own source documents repeatedly and very clearly flagged the risks from U.S. tariffs and this potential ICRA Act tax on services exports. At the same time, they're banking on strong domestic consumption to drive India forward. So the question is, how will this fundamental tension relying on robust domestic demand while simultaneously facing these potentially very harsh external trade headwinds actually play out? How will it shape the real growth path for Indian companies, especially those big in services exports, for the rest of FY 2026? It's a balancing act that even ICRA itself will be watching closely.